Join me on a magical carpet ride to find the best ways for wealthy retirees to save money on taxes and keep more of their wealth. Hi, my name is Tommy Cloud. I'm president of Third Act Retirement Planning. It's a company that I started back in 2000. I'm also a certified financial planner and qualified Kingdom advisor, as well as I studied finance in college. So when people with a lot of money retire, they face special money challenges, we'll call them. One big challenge is figuring out how to pay less taxes, of course. As they stop working, where their money comes from, and how much tax they owe can change substantially. It's important to have a good plan to make sure they keep as much of their money as possible. We want to understand what these tax challenges are. Wealthy retirees often have a lot of money saved up, which can make their taxes complicated. For example, if they have money in things like stocks, mutual funds, or ETFs, they might have to pay a lot of taxes. And we've talked about tax loss harvesting in other videos. And these taxes on capital gains can slowly take away from their savings. They also might earn money from things like dividends or selling stocks, which can push them into paying higher taxes. Another big challenge is planning what happens to their money after they pass away. They need to think about how to give their money to family or charities without paying too much in taxes. Now, this is going to apply to people whose estate is going to be above the threshold, whatever it is in the year that they pass away. This can be tricky because on different taxes, like estate taxes or gift taxes, they're going to be due depending on if those thresholds are broken. And the lifetime uniform gift tax is due on how much you give away during your lifetime that exceeds the amount that's allowed each year. There's a certain amount that couples can give away each year to their loved ones, friends, or other people without triggering the uniform lifetime gift tax. We'll call it clock, so to speak, as it begins to record how much you give. Plus, they might own things like houses or businesses that aren't easy to sell. Houses, I would say, are easy to sell compared to businesses. Only about 20% of business owners are able to sell their business. So this can make planning even harder. And when you consider that capital gains rates on businesses are going to be taxed at the highest rate, it's definitely something that you'll be able to want to plan for. So what are some smart tax strategies? Let's talk about that. To handle these tax challenges, wealthy retirees can use tax smart strategies. One way is to carefully plan how they take their money out of their retirement accounts. This can help them pay less in taxes and keep more money. So giving to charities is another good strategy. It can lower their taxes and help causes they care about. A special tool they can use to give to charities is called a donor advised fund. This lets them give a big donation to charity and get a tax break right away. Then they can decide later which charity gets the money. So this is also called bunching. So for example, if you had $200,000 that you wanted to give away, you could give away $200,000 in 1 year to a donor advised fund and get that entire write-off. Each year we have a standard deduction. And let's just say the standard deduction is $30,000. So if you give away $25,000 a year, you don't get to use any of the amount above the standard deduction. You're going to get the $30,000 anyway if you're a married couple in this example that I'm just making up here. Let's say we're talking 2 years. Year one, you give $100,000. Year two, you give $100,000. You're only going to be able to deduct $200,000. But let's say year one, you give $200,000 and year two, you just use a standard deduction. You're going to be able to deduct $230,000 over those 2 years rather than just $200,000. And this again is called bunching charitable contributions. And we also can see that done with like real estate taxes would be another example. So what's the importance of planning? The key for wealthy retirees is to plan ahead. By using these smart tax strategies, they can keep more of their money and give to causes they love. It's all about making sure they can enjoy their retirement without worrying too much about taxes. And this gets into the softer side of things. Warren Buffett stated today that he was still planning on giving away 99% of his $150 billion. That's pretty impressive. In the end, planning for taxes is super important for wealthy retirees. By understanding their unique challenges and using smart strategies, they can save money and enjoy their retirement more. If you have ideas about tax strategies for wealthy retirees, feel free to share them and I'll comment on the ones I see. And if you want to learn more about managing money, stay tuned.